Hello, Jim here. I've been trading options going back over 13 years. I primarily started with really good value companies that pay dividends and also grew dividends quite nicely. I want to talk a bit more about that. I have a couple of companies I want to share with you today. And I also want to talk about my Coca-Cola stock. It was given to me back in the early 80s, and I want to share with you what the appreciation looks like on Coca-Cola going back literally almost 45 years. So stay tuned. I think you're really going to enjoy what I have for you. Okay, let's start off with talking about appreciation. How shares, if you keep them many, many years, they can appreciate and grow to a huge amount. Now, I'm first going to talk about my Coca-Cola shares. They were given to me by my grandfather back in 1982. And at that time, they were, I believe they were 30, 40, $50. Coke seems to keep their stock in a specific range. Usually it's between 40 and 65 or 70. Once they get over 70, they typically will do a 2-for-1 stock split. So I had 100 shares that were given to me back again in January 1982, and that stock has appreciated a huge amount. If you look at it, it's literally like a 5,000, nearly a 5,500 increase, literally 55.77 times in value since 1982. And then also the dividends have grown. Every year Coke has paid a dividend, has increased it, and it also has increased to a huge amount. Originally, it was paying 10 cents per share. Now it's paying $1.84 per share. And that's almost like an 1,800% increase, 1,750 or 18.4 times since 1982. So you can just imagine, how much this has grown. And it was just 100 shares. It wasn't a huge amount of shares, but over time it's just, morphed into a fair number of shares and also a fairly good value and a fairly good income stream. So back in 1986, it had a 3-for-1 stock split. So Coke has had splits going all the way back, in the 70s and 60s and 50s. But since I didn't own them until this time in 86 were the first time the shares that I owned split. They split three for one. So suddenly those 100 shares were now 300 shares. Then in May 13th, 1990, I had a 2-for-1 stock split. So those 300 became 600. In May 25th, 1992, another 2-for-1 stock split. And again, it went from 600 to 1,200 shares. So suddenly in 1992, I had 1,200 shares of Coca-Cola. Then again in 96, another 2-for-1 stock split. So it went from 1,200 shares to 2,400 shares. Now, in 2012, which is about the time I started selling covered calls after, what happened in 2008, and it was really 9 and 10 also when we had the recession and the market took a pretty big dive. I started looking for other ways to make some money. So again, another stock split. It was a 2-for-1. So suddenly I had 4,800 shares. I'm like, what am I going to do with these 4,800 shares? I'm earning a pretty good dividend at the time, but what else can I do? At that time, the internet, there wasn't really anything on the internet. I'm not even sure. YouTube may just be in its infancy at that time. But I went to the next best thing. I went to Barnes & Noble, and as I typically still to this day like to do, I grabbed a cup of a mocha and looked around, picked up some books, and found a book about options. And that's where my whole journey started. So at that time, I had 4,800 shares, and for the longest time, that's all I did was covered calls. I would just sell a couple covered calls probably once every other month, like I might do 3 or 4. Now, to sell options, it's gotten relatively cheap, but back then, again, we're talking 2012, this was before all these major cuts and what the fees are. Back then, you didn't want to make a lot of trades. You'd want to do a few trades because it was quite costly to make a trade. I can't remember exactly, but it usually was a couple of $100 of fees. You definitely had to put a lot more thought into it. So at that point, I started selling covered calls, and it would made a really good income stream for many, many years. Again, going all the way back to 2012. I only 3 years ago, actually, it's more like 3.5 years ago, I started to want to learn the right way to trade options. Before that time, all I did was say, well, if Coke got up to 75, I'd be willing to part with a couple hundred shares. I didn't know anything about Delta or the Greeks. I didn't know anything about, how you could close positions, you could roll them. I didn't know any of that. I just would sell options and it worked great. I very rarely ever had anything called away from me. That's another reason why I did decide to start this journey is I did have a number of positions called away from me in 2021 when the market kind of shot through the roof. And I think I had 300 or 400 shares called away from me. And that really started my journey. That got me thinking, what am I missing? And then I started doing more research and then started learning about calls and, all these other strategies, iron condors, spreads, vertical put credit spreads, strangles, straddles, all sorts of interesting. It took me down a new realm. And plus YouTube was pretty active at that time. So that's how I kind of got into it. So it's kind of mind-boggling to think 100 shares turned into 4,800 shares. The current stock price is $66.92. It did drop a bit. I believe this week it drops from, I think, 72 or 72, 73 to 66.92. But even at 66.92, that's a value of 321. So a gift given to me from my grandfather over 40 years ago, 42 years ago, has morphed into, and I believe his original trade was right around $300. I don't know. Yeah, $3.12 per contract, or not per contract, per share. So he spent 300, and here I am 40 years later, it's turned into over 321,000. So I just wanted to share that to give you a perspective. When I talk about appreciation and that I'm in it for the long term, when you start thinking outside of 6 months or even monthly, when you get into trading options, you start looking at options on a monthly basis and you start looking at stocks more in the short term. And that's where I'm an investor. I still prefer to hold a lot of these positions for long term. And Coke isn't the only one I've held for a long time. I've also held the other two I wanted to talk about today, Johnson & Johnson and Proctor and Gamble. So they're also at a very good price. So let's jump into, we'll start with Coca-Cola. Look at what Coca-Cola looks like now. If I go 10 years out, you can see it. It tends to go up. It trended up, then it came down, and then it trends up, and then it came down. I think for Coke in the low 60s, right around 60, maybe in the high 50s is a really good area to purchase it. It doesn't have a crazy PE. It's currently 23, which is a little bit high. Long term, I think the PE's been more like 18 or 19. But we can look at earnings. It typically almost always beats earning. I can't remember the last time they did not beat earnings. And there's small mover. You can see very small increases in your earnings on a quarterly basis. But they typically always grow earnings. Now growth, they don't grow a whole lot. They're growing a little bit more recently. They at one time had a CEO who was more of a financial person and they didn't do as well. But over the last 4 or 5 years, they've done better. Profitability, they've always been very profitable. You can see nearly 40 on return on common equity. Return on assets is like 9.8. So very good with that. If we look at dividends, they do pay a lot out on dividends. This used to be a lot higher. It used to be like 80 or 90. So they've been increasing dividends not quite as quickly as they used to. It used to be, on average, they would grow dividends like 6 or 7% yearly. Now they've reduced that and they've lowered their payout ratio. So the dividends are much safer than they were just a couple of years ago. Now, to get a better perspective, if we go to Coca-Cola and we look at dividends here, I like how Coke does it a little bit better. Not Coke, how Schwab does it a little better. If we go into the details, you can see here they've been increasing dividends for a long time. And if you look at the numbers, if you just bought them back in 2014, you were paid $1.22 in dividends, and now they're paying $1.48, or $1.46. So it's not a huge difference, but still it's a lot more than what it was originally. And then if we look at debt, which is the other thing I like to typically look at, Coke does have more debt, but they are a giant company. They pretty much do their own debt financing, and it stayed the same for many, many years. Here's their equity. So their debt is fairly high, which isn't unusual for this kind of a company. And I worried less about these giant value companies that have been around for so many years. So that's Coca-Cola. Is it a good buy now? I don't think it's a bad buy. If I was to make a new position, I'd probably try to get in closer to 60. You don't see it as much here, but 60, I believe 60 or low 60s would be probably a good entry point. I like to use what's called a 15 delta if you're selling a put, and I believe that's probably pretty close to 60 or slightly below it. Now, the other two companies I like are Procter and Gamble, and I've owned Procter and Gamble a long time. Similar story as Coca-Cola. The appreciation and the dividends have been quite substantial. Profitability, just like Coca-Cola, is way up there. They're very profitable, very good company, 11.32% for return on assets. Common equity is nearly 30%. If you look at earnings, it's typically beats earnings, just like Coca-Cola. Sometimes it misses on GAAP earnings, but typically not by that much. They're growing a little bit more than Coca-Cola. This is probably averaging pretty close to 6% on a quarterly basis. So they are improving on their profitability and their earnings growth, similar to Coca-Cola's, maybe a little bit higher than Coca-Cola's. So they are growing. And then dividends, their dividend isn't as high as Coca-Cola's, 2.39%, but they are growing it quicker, almost 6%. And they've been dividend growth that's been over 68 years. So a lot to like. Now, again, let's look at their debt. Oops. Yeah, I'm in Procter and Gamble. So let's look at their dividends first. We'll come down to their dividends, and you can see here a nice steady increase over the years. And they used to be, here's 9%. I believe they've also reduced their growth in growth in dividends compared to what they used to do a couple of years ago, which I like to see that. I want to see them to continue to grow. So 10 years average is 4.6, 5 years 5.7. So actually they've increased it. They've kept it about the same for a good number of years. Now, if we come down to debt, 32 on about 50. So I like their debt to equity a bit better than Coca-Cola's. They're fairly close to what I call a 50% debt to equity. So for every dollar of debt, they have $2 in equity. They're not quite there, but they're fairly close. So, and over the years, it looks like they've stayed pretty close to this, between 32 and 34 billion of debt, which is fine for a company like them. And like I said, I've owned them for a long time. So if we look at their summary page, they've also come down recently. And if we go out 10 years, this way we can get a better feel. They haven't shot through the roof. Their PE is like a 24, which their PE typically has been a little bit higher than Coca-Cola's. Their earnings per share looks good. What level would I probably look at getting in? I like them right around 160. So if we go back to a year, it'd be right around here. 155 might be a little bit too low, but a typically good company. Both Coca-Cola and Procter and Gamble have fairly good amounts of dividends and plenty of open interest, plenty of volume. Typically, this is November 15th, and they typically have plenty of expirations. Again, Coca-Cola, very, very similar. Now, if we look at the last one, Johnson and Johnson, another great company. And if we come over here, we can see that it's also come down recently. With last week was a little bit of a rougher week for the market. Its PE is a bit lower. Its earnings, so its PE is like 16. And then if we look at its profitability, very good again, similar to both Procter and Gamble and Coca-Cola. Return on common equity 20, a little bit lower for return on assets. Dividends, they've been growing them 5.61% over 5 years. They pay a little bit over 3%, and they've been growing dividends for 61 years. If we look at that same thing for Procter and Gamble, 68 years. And then if we do Coca-Cola, same thing at 61 years. Make sure we're in Coca-Cola. So all three of these companies have been growing dividends a long time and have done quite well. And I typically have been able to more than double these dividends. So if I sell covered calls, I've been very successful with doubling the dividends. Now, I don't think we've looked at the debt for Johnson and Johnson. And let's dig a little deeper into the dividends. So if we look at the dividends, here you can see they've been growing them a bit faster than both Coca-Cola and Procter and Gamble. And if we go back from 2014, they paid $276, and now they're paying $357. So a nice increase, not about a 50% increase. I don't think we looked at this for Johnson and Johnson. Let's look at Johnson and Johnson. Sorry, I'm jumping all over, but I really like doing this. So they might have actually reduced dividends between 23 and 24, or they had a special dividend. You'll see sometimes a special dividend, or they may have one more to pay is what my guess is. But 276 to 470, so they've almost doubled. If this year it's going to be closer to $5, then they've in 10 years nearly doubled the amount of dividends that they pay. Now, if we scroll down and we look at their debt, between 29, so they've been paying debt down. They went from 39 to 29, and it's right there at a 50% debt to equity ratio. So for every dollar in debt, they have $2 in equity. So I like them the best from debt to equity. And you can see they've come down a little bit more recently. So, and just like the others, let's look at growth. They're growing about the same. That's why these are value companies. They don't grow gangbusters. They grow 5% on a yearly basis. But it's almost like clockwork. Now, if I was looking at getting in on them, actually, I'm back at Coca-Cola. Let's get back to Johnson and Johnson. And let's go back to their growth. So their growth isn't as good. It looks like they've got decreases in some of their earnings. Revenue is grown a bit year over year. So their earnings don't look quite as good. Since we were looking at Coca-Cola, I figured we'd jump right back into this. Now, where do I like them? They're currently right around 160. If we go out 5 years, you can see they've been trending down a little bit. They trended up and now they're trending down, but they're not way off. If their low was back in 2020 with COVID, but they haven't moved a whole lot. And that's what you also find with value companies. They're more consistent. If the market takes a dive, they typically don't dive quite as much. And they pay, about 3%. So you can double that. I typically have been able to double it with them. Sorry about that. I dropped my mouse. So you can see all three of these companies do well, and they all have plenty of options volume. So they're a good company. All three of these are good companies to be selling covered calls on. I'm looking at November 1st, but if I look at November 15th, you can see typically has pretty good options premium. And then, of course, if you go farther out, a lot of times I will go 6 months out with a lot of my covered calls. So if I did something like January 17th, you can see if you go to around 170, which would be about $10 above where they are now, you're talking $1.73. Or if you do something closer to the money, so again, good premium, good number, good amount of volume. If we go back to, let's just look at lots of open interest. And that's the case for all three of these. So all good companies, all companies that I've owned for many years. I've owned Johnson & Johnson for probably over a decade, and same thing with Proctor and Gamble. And I have them in a mix of different accounts. I have them some in my regular brokerages and some in my retirement accounts. So good companies to trade, good, consistent, and like with Coca-Cola, you own them a long time, you pass them to future generations. It can be a huge amount of money, and the dividends, just like Coca-Cola, with them increasing them, they can be a substantial amount of income down the road. So that's what I wanted to share with you guys. Let me know what you think. Do you like these three companies? Do you have other companies you might suggest that could even be a better fit or maybe pay a higher dividend? So thanks for joining me. And as always, if you leave a comment, I try to answer the comments usually within 24 to 48 hours. So thanks for taking the time to watch the video.